Welcome back to the Everything Financial Radio Show here on the Legacy Radio Network. We are pleased to be chatting with Mr. Harry Dent today. Harry's most recent book, The Great Crash Ahead, is certainly must-reading. And Harry, just in case someone would like to learn more about your work, what would you advise them to do?
Yeah, just go to our website, hsdent.com. We've got a lot of free reports and information. We can get a sample of our newsletter. Just get more familiar. I mean, we look at demographic trends, which is the ultimate leading indicator. It's the only thing that will tell you, not just years, but decades in advance, when people are going to spend money or not, when they're going to borrow, when they're going to invest, all types of things. Almost the longer-term trends couldn't be more clear. The hardest thing is figuring out short-term trends with all the speculative swings and all the government, stimuluses and stuff like that. The long-term is actually, we've been predicting this downturn for over 20 years, and we predicted the Japanese downturn in the late 80s before it happened, when everybody else was just projecting their growth into the future like they're doing with China today and saying Japan's going to take over the world. Demographics would have told you Japan was going to slow down ahead of the rest of the world, and now all the major developed countries, almost all of them, are going to experience the same slowdown a decade and a half later, and the same real estate bubble burst that Japan had, the same stock crash that didn't come back for many, many years, and the same slow economy for a long time. So we got a decade at least of winter ahead of us, and governments trying to kick this can down the road by just throwing money in the economy to cover over all the bank losses and all the real estate losses and all the problems. They're just stretching out the downturn like Japan did. People should know that Japan still got stock markets down almost as much as the bottom, down 78% today, 22 years after the top. They still got real estate markets down 60%, 21 years after that top, because they've done what we're doing. QE, take more drugs to ease the pain. Don't deal with the big debt problem. Don't let debt deleverage. Don't let banks fail. Well, in the 1930s, the U.S. let the banks fail, and in 3 years, we had the biggest debt detox in all of history, and we did nothing but grow out of that and became the strongest country in the world. So, yes, short term, it would be more painful if we allowed this debt to deleverage. But long term, we're going nowhere like Japan if we don't deal with this. And this is insanity. I think the people should be hung for what they're doing. This is the most immature, short-sighted thing I've ever seen. You can't believe that grown bankers and PhDs and economists and people in pinstripe suits are basically recommending that we take more crack to keep coming down from the bubble high.
Harry, that comment leads to many questions, but the first one that pops to mind is, if Harry Dent was in charge of U.S. fiscal policy, what action, in your view, from a policy perspective, would be the right one?
Well, my thing would be, we had a debt bubble, greatest in history. We let it go way too far. That was government's responsibility. That was banks, regulators. Everybody screwed up, even consumers. We consumers borrowed more and bought bigger houses than we deserved, and we kind of knew it. We just did it. So I would say, look, recognize we had too big a bubble. The goal is, how do we deleverage this debt bubble in the most sane, civilized way? I mean, if the economy just blows apart like the early 30s, it's going to be very violent. It'll happen quick, like diarrhea, but it'll be very painful. But if you do it like Japan, and we've been doing it, you'll stretch out this crisis forever and make it worse. What I would say is, here's my stimulus policy. Banks have to write loans down to market. Mark the market, and the government will only provide limited stimulus, let's say 30 cents on the dollar, for every dollar that a bank or financial institution writes down for a loan to a business or a consumer, and certainly especially real estate loans. So we force debt to deleverage. We don't let the banking system totally fall apart like in the early 1930s, but we let the strongest banks survive, and they take over the weakest banks. Because people always say, oh, bankruptcy is terrible. No. If a company in an industry goes bankrupt, then the other companies just pick up their assets like vultures at low prices. Customers don't, get interrupted service and all that for long. It just forces a consolidation and more efficiencies and a lot of mergers and consolidations and a lot of cost cutting, and all of that makes us stronger long term. So, yeah, I would have the government try to orchestrate the crisis. So it's kind of like a drug addict coming to a doctor instead of going to cold turkey, and the doctor brings them down a little more slowly, but the goal is we have to restructure debt. I would measure the success of fiscal and federal and monetary policy is how do we get $42 trillion in private debt, the greatest bubble in history in the United States, for example, down to pre-bubble levels, which is about $20 trillion. If we took that $22 trillion load off of the private sector, even in a slow demographic period, which we've got for the next decade, you would free up cash flow dramatically. Iceland, Estonia have already done this. They didn't do what everybody else did. They're small countries, but they've turned around their economies already, while Europe and the United States and everybody else keeps falling back into recession. You've got to deal with the debt. And so that's got to be the target. And you don't do some whole new health care plan like Obama did. You deal with the economy, you deal with the debt, and then you got to restructure entitlements, because we can't even afford half of what we used to have, nevertheless what we've been promised now. And health care is the biggest monster, Medicare, Medicaid, ever, and there's not a chance in hell we're going to get even half of any of those benefits in the future decades, so we might as well restructure them now. First of all, somebody made a great comment. I think it was George Will. He said, if we had just simply adjusted Social Security and, for example, benefits in retirement age for rising life expectancy since the program was started, we'd be retiring at age 75 today, and we wouldn't have a Social Security deficit. We can't retire at age 63 on average, which is the average, and live to 86, which is the average if you reach that age, and be on the dole for 23 years playing golf and shuffleboard with full Medicare, Medicaid benefits. We are totally out of reality. All these benefits were promised in another era. They've continued in the boom, and now people just want them. Well, sorry, you can't have them. We need a big reality. My view is, with government policies the way they are, with the public in la-la land, we're not going to get this reality unless we have a major crisis and the system melts down after all this stimulus, and we're forced to realize, consumers and citizens, companies, banks, government, economists, everybody's forced to realize we are bankrupt. And no, we're not bankrupt long term. We're a great country, but we have to go through a Chapter 11, restructure our assets and our debts so we can get back to sanity and move forward, and particularly so young people can afford a house again. Young people can afford health care again. I mean, this bubble has made everything unaffordable. It's benefited older people that own all this real estate and assets, but it's killed young new families coming along. And the youngest families now in Japan, well, they don't have families. Young Japanese just have accepted lower wages, no benefits, and they're so depressed they have no interest in sex or marriage, which means they have no future, because if you don't have kids, which they already haven't been doing for decades, you have no future. So we're going in the wrong direction. I think a crisis is going to force us back in the right direction. Not Romney, not Obama. There's not a person running that is anywhere close to reality. Harry, you're not going to reduce taxes at this stage and reignite the economy, and you're not going to keep spending and borrowing money and make the economy healthier.
You just went where I was going to ask you the question, because there doesn't seem to be any political will to take on these problems head on. What does this crisis look like, and how does it affect people?
Well, what I think it looks like, QE1, QE2, QE3, each one has less impact. You see it in Europe. They keep giving these bailouts to Greece and Portugal and Spain and all these countries. Well, that just piles more debt on more debt. At some point, the system breaks. You get a run on the banks in Spain. You get banks who've been holding $4 million of foreclosures back forever finally say, God, we got to dump these things. We need the cash flow, and home prices aren't going to come back like we thought. You get some, China's real estate bubble, which is the worst in the world, finally just cracks and breaks down. All it takes is a straw to break the camel's back. The system is so stretched with debt for so many decades that the system just melts down. And it's kind of like 2008, where the subprime loans started melting down so fast that the government just couldn't get ahead of it for a while, and you have a big crash. And this time, if we have a big crash, real estate goes lower. This time, if we have a big crash, the real estate collapses, not just in the U.S. and parts of Europe, but China and other places in Europe and Canada where they didn't. And at some point it gets so bad that people, a new president comes in or whatever, some point, and people say, okay, it's time for FDR. We got to have a bank holiday. We got to restructure everything, and then you get on the right road. So the key for investors in business is get out of the way. You're a business, don't plan on the economy get better. Hunker down, be mean and lean, or sell your business now. And if you're an investor, I mean, every time we bubble back up in any of these markets, and stocks have now bubbled back up with all this stimulus for 3 years, get out of stocks. We told people in late June, get out of stocks. We told people last week, Wednesday, more aggressive investors, it's time to start shorting stocks. If you want to short and bet them going down, high chance of a crisis this summer and fall. And wait for the crash to happen like Joseph Kennedy did in the early 30s. Then you can buy everything 20, 30 cents on the dollar. Beachfront property, stocks, companies, or you can buy out your competitor and your business that went under out of bankruptcy for 20 cents on the dollar and double your market share. I mean, there's huge opportunities here, but you got to get out of the way. If you're just floating down the river and you go off the waterfall, you're going to break up and you're going to hit the rocks. And that's what most people did in 2008. And guess what? Most people are going to do it again. Everybody's believing Warren Buffett, Obama, Ben Bernanke, and it's saying, hey, don't worry, we're not going to let us go into another downturn. I'm sorry, these guys are going to fail.
Here we've got just under 2 minutes left. Give us your outlook for the stock market moving ahead.
Well, you know, we got two scenarios here. We're convinced that the next crash, which is going to take us lower than the first one, somewhere between, say, 3,000 and 6,000 on the Dow, is going to, it's going to deepen. It's going to get sharp this year or next year. So our scenario one is we get a more minor, maybe a 20% crash, into the summer or fall, and then you get a big QE3 around the world, and we bounce into early 2013, and then the bigger crash comes into late 2013 and the aftershocks into late 2014, and then we start to head up again. Scenario two is that Europe gets so bad, and it's starting to blow up already, and Spain's going to break Europe's back. That's our forecast for all types of reasons. You get the bigger crash this year and aftershocks into 2013 and 14, but you get the bigger crash this year. So that's why we're telling people, hey, if we thought 20% was the limit this year, we'd say, hey, maybe you want to hold in for a while. But we're telling people recently, get out, because the odds are growing that we could get the bigger crash this year and not next year. But either way, we see a major crash between early 2012 and late 2014. That's the danger zone for our view.
Harry Dent, thank you for joining us today on the Everything Financial Radio Show. Very much appreciate your time. And the book is The Great Crash Ahead. Everything Financial Radio will return after these words. Stay with us.